Good morning, everyone. Good morning, everyone. My name is Jennifer Martin Tukundia, and I'm the chairperson of the Capacity Building Committee of the Association of Banks, Legal Advisors, and Company Secretaries. I'd like to formally welcome you to today's session on the review of security documentation, enhancing capital adequacy, liquidity ratios, and regulatory compliance. I think today is going to be a very interesting one, which promises to be very informative, insightful, and thought-provoking. This training is part of a two-series session, with the second being facilitated by Professor Graham Penn. Although that's going to be on the 13th and would be both physical and virtual, but the physical session would be more limited to certain participants that would be invited separately. The sessions have become extremely important, particularly because of the recapitalization of banks and the role that banks would play going forward in the development of the Nigerian economy. For today's session, we have a very senior member of the bar to facilitate the training in the person of Mr. Osaro Eghobamien, SAN. Mr. Eghobamien is one of the founding partners of Perchstone Graeys. He's also the managing partner of the firm and currently leads. So I was just saying that Mr. Eghobamien will be leading today's session. He will facilitate today's session. And he's one of the founding partners of Perchstone Graeys. He's also the managing partner of the firm and currently leads its dispute resolution and banking and finance groups. He's a director of the Convention on Business Integrity and a member of the Mortgage Implementation Committee of the Financial System Strategy, FSS 2020. He's also a member of the committee that built the framework to create the Gelegele port in Benin and serves as the chairman of the subcommittee set up to review the proposed amendment to the Asset Management Corporation Act and the proposed bill for a regulatory framework for securitization and asset-backed securities on behalf of the Legal Implementation Committee. Mr. Eghobamien and his team were part of the team of lawyers to the Debt Management Office appointed to advise on the restructuring of Nigeria's 3.3 trillion naira legacy debt. They also advised on Nigeria's liquefied natural gas train 3 and 4 projects, which were the first and third largest third-party financing in the liquefied natural gas sector in Africa. He's a notable speaker and has made presentations on securitization, financial derivatives, and the capital market. He has delivered papers at the National Seminar on Banking and Allied Matters for judges, NDIC workshops, the Central Bank of Nigeria, the Securities and Exchange Commission, and various commercial banks. He has facilitated a number of trainings on local law perspectives of securitization, covered bonds, and liquidity facility. I think Mr. Eghobamien is best suited to give us this, to facilitate this training today. And so it is with great honor that I welcome Mr. Eghobamien, SAN, to proceed with the training. Thank you very much. Mr. Eghobamien, please.
Jennifer, thank you for that introduction. When I call Jennifer, I'm almost tempted to call her by her maiden name, Jennifer Mosua, because Jennifer and I were obviously in the same office for quite a long time before she moved on to higher grounds. Jennifer, thank you very much indeed. Let me also thank a few people that I know very well at the BOT. I'd like to start by thanking Mr. Yemi Adeola, the chairman of the Board of Trustees, somebody I know very well. I was very helpful in my early days in career, in my early days in the career of the practice of law when he was the company secretary of Citibank. I want to also thank Angela Omodare. Also, she was Company Secretary of IBTC. I worked alongside Remy. We did some work for IBTC. And finally, I'd like to thank Nke Chunwusu again. She used to be at Diamond Bank. We did some work for her at that time. I'll also mention Abimbola Isu, who's also a trustee, Tijani Borodo, who's also a trustee. I thank you very much indeed. And I thank all those who've put this together. I consider it a great privilege to share knowledge. I know Jennifer said is a lecture. It's not so much a lecture, it's to share knowledge with my colleagues. Before I start, and I'm going to be using some slides, but before I start, I'd like to make 3 preliminary comments. The first is that, of course, on March 28, 2025, the central bank came up with this prescription that all the banks in Nigeria, that 2 years will be required to capitalize, whether you're international, whether you're domestic, regional. There is an increase in the capital of each bank by the rate of almost 2,000%. It's one thing to raise the capital, is another thing to decide how that capital is deployed to obtain return on investment, to ensure there's compliance with Basel III, and most importantly, to ensure that capital adequacy continues to be maintained. So that's the first thing that's happened, and it's going to revolutionize the way we practice banking in Nigeria come next year. The second thing that is interesting and significant is that there's a serious move to proceed to comply with Basel III regulations. And by that I mean there is now an emphasis to determine capital adequacy by the quantum of risk-weighted assets on the books of the bank. That is very interesting because that also has increased the percentage ratio of capital to the risk-weighted asset is what will determine your capital adequacy. That's very interesting, and we'll come to talk about that in due course. The final point on this new program is that if you look at the letter which was issued by Central Bank, it states categorically that if there is a failing in the ratio of capital adequacy, the only way in which it could be enhanced is by introducing new capital. In other words, either you go to the capital market or there's a merger. That's the only way in which you can improve capital adequacy to comply with the prescription. That is not how it is done in other parts of the world. If there is a failing in capital adequacy, you could adjust your risk-weighted assets naturally, and this will usually be done either by sale or by taking a charge over the assets. You should be able to structure your balance sheets by some adjustments to capital, to the risk-weighted assets. Unfortunately, the tools that are necessary to meet the stringent criteria now in Basel III are not absent in our regulatory system. And this is one of the things that we're going to be engaging the central bank in so that banks can have the flexibility to do to restructure their balance sheets in accordance with the prescription in Basel III. Now, okay, so basically, I'm going to Jennifer has told me what is most interesting, what the most interesting part of this lecture should be based on your security documents. And I'm going to focus on that. And I'm going to focus on the security documents, collateral, how you take collateral, and how it impacts on your capital and capital adequacy. In doing that, I will then look at specific clauses. I will look at specific clauses and see how and whether those any risk has been covered as a result of those clauses. So what I usually get when I engage with bankers is to say the documentation is lean. And the reason that the documentation is lean is because there's an attempt to cover risk, particularly credit risk. and then also draft the security documents so that it is watertight. However, bankers would usually say that customers are rejecting those documents, but they are bulky. I will look very carefully at the consequences of having an overly security documents. Ordinarily, when there is a failing in a loan, what normally happens is that you apply to the bank and you're thinking of converting the collateral to liquidity.